In this screencast, we are going to complete our work with Paulus Consulting in the variation on problem P1-4B from Financial Accounting, the 8th edition by Weygand, Kiso, and Kimmel. So when we left off, we had just created all of our adjusting journal entries and recorded them in the general journal J2. Now, just as we did with our journal entries in J1, our general journal, we need to post those to the general ledger. And what I have done is I have already done that posting, and I have transferred over our general ledger. And what I did here was, this is all what we saw before when we posted to the general ledger, but you can see where you see the J2s in red, that's where I've posted our additional adjusting journal entries. So you can see the accumulated depreciation equipment. This is a new account. Since it's a contra asset account, it goes with equipment. We put it right after that, even though it has a credit balance. It does not go with liabilities. It goes right with the equipment. And also we've created salaries payable, a new payable account, a new liability, interest payable. And you can see that I have posted all of these different journal entries to the general ledger. So after we've posted our adjusting journal entries to the general ledger, then we can create a new trial balance. And we are going to do that. So as you can see here, we have our unadjusted trial balance just as we had before, although I have added our new account names to it. So what we need to do is we need to adjust this, and we need to change it to being correct. And you could put in more columns with debits and credits and put the journal entries in there, but we're just going to do it right here in this debit and credit column. So the first thing that we need to adjust, we look at what we need to adjust, and we didn't adjust cash or accounts receivable, but one of our adjusting journal entries had to do with supplies. And if we look over at supplies, our balance isn't 1,000 anymore, it's 400. So we change that. And then we can go down and we have this new account, accumulated depreciation equipment, which has a credit balance because it's a contra asset account. It's the opposite of an asset. So it has a normal balance of a credit balance. And we created that general ledger account, and sure enough, it has a balance of 38, which is a credit balance. And we put that in there. Next, we look, our notes payable did not change in our adjusting journal entries, neither did our accounts payable, but now we do have salaries payable because we did do an adjusting journal entry for accruing salaries. And our salaries payable balance is over here, and it's $2,100. And we also have interest payable because we had that 6% interest on the note. And being a payable, it has a credit balance, so we put that in. Our common stock did not change, neither did our retained earnings, nor our dividends. Our service revenue did not change. Our salaries expense did change because of that accrual. If we look at our salaries expense before we adjusted it, the balance was $2,100. Now it's $4,200, and so we need to change our salaries expense to $4,200. Our rent expense did not change. Our advertising expense did not change. Our utilities expense did not change, but we did create a supplies expense. We took into account those supplies that were used, and we have a $600 supplies expense that we recorded. We also recorded depreciation expense of $38 and interest expense of $25. That would be an error. So once we've made those adjustments, now we don't have an unadjusted trial balance. We have an adjusted trial balance, and it does balance. Next, we can take that information and we can create our final set of financial statements. And these are the financial statements as we did them before, and I've just added the new accounts. And so what we need to do is we need to look at all of these different statements and make our adjustments to them. Normally you would just start new, but it would take us too long to write all this in. So one thing we know is our salaries and wage expense changed to $4,200. So we can do that. Rent expense did not change, neither did advertising or utilities. We have a supplies expense, we will add that. We have depreciation expense, we will add that, and we have interest expense, and we will add that. And we come down to net income of $437, which means this $3,200 is not correct. It's $437 because that income statement, net income amount, rolls right down into the retained earnings statement. Our beginning retained earnings did not change, neither did our dividends, so we have $537. As we move down to the balance sheet, we have $17,700, that did not change. Our accounts receivable didn't change, our supplies changed, we only have $400, and we now have accumulated depreciation, which is recorded as an asset, but a negative asset. Did not change our notes or accounts payable, but now we have salaries payable of $2,100. And we have interest payable of $25, and our retained earnings, of course, changed. And as you can see, our balance sheet balances, and now we have completed our income statement, retained earnings statement, and balance sheet, and we are finished with what we are going to do with this problem.